You may use the webinar ID seen on the screen to reconnect. Let me now turn you over to today's webinar host.
All right, good afternoon and welcome to our event entitled Building Your Financial Safety Net. I am Mon Osmeña and I shall be your host and moderator this afternoon. The market volatility of last year seems to be continuing in 2023 amid sticky inflation, central bank rate hikes, fears of US recession, and now fears of a banking sector crisis with the collapse of several US regional banks. Next slide, please. US bank runs on several collapsed banks have rocked the news in the past 2 weeks, marking the first bank failure since 2020 and some of the biggest since the 2008 global financial crisis. The US government said they'd protect 100% of depositors' money, but worries on the banking stress contagion still linger. One of the biggest banks in Europe, Credit Suisse, was just bailed out by the Swiss National Bank. And the latter also arranged a full merger buyout from its rival UBS. What's going on in the global banking sector? Will the extraordinary actions of the central bank save the day once again and avert a global financial crisis? For the audience here, if you do have any questions, you can leave them on the QA box below and we'll try to entertain them later on. Although no one can predict how long these investor worries may linger, we believe this year's episode of Market Volatility is creating opportunities for long-term investors across asset classes. We've invited a very special speaker to share his views on the pressing global market issues now. But before we get to that, here's a poll question. So you're seeing on the screen, we only have one poll question. Pampagising lang po ito. Among the choices here, which one here applies to you the most this 2023? Am I full on revenge spending? Am I buying a new bag, a new car? Am I splurging on travel this year? Nag-release si PAL ng promo on the tickets, right? So are you guys going to be traveling again this year? Or am I going to keep my money in cash? So please, I'd like you guys to answer the quick poll. The last one also, it says, I'm taking this market opportunity to invest for the long term. So let's give it a few more seconds for everyone to answer the poll. Our speaker is also curious to see your answers here because he actually suggested this poll question for you guys. No, so let's end the poll in 5, 4, 3, 2, and 1. If we can share the results, please. Wow. Okay. Uh, I guess we're doing something good. Most of you guys, so 65% are saying I'm taking this market opportunity to invest for the long term. Very, very encouraging, and I think you guys are smarter than a lot already. So based on this survey, this is something very encouraging for investors and for clients and for the markets. No, great answers, guys. Thank you. So moving on. I'd like to introduce you guys to our very special speaker today to help us understand what is going on around the globe, the banking sector, the markets, and where to invest now. We are pleased to introduce our speaker for today. Andrew Gan set up the private banking and investment management for the then Manufacturers Hanover Trust, a predecessor of JP Morgan Chase Bank in 1988 and has remained in that industry ever since, working with a number of banks before eventually setting up Beacon Holdings in 1999. Andrew Gan is now managing director of Beacon Holdings, which is a multi-family office whose clients include nonprofits, religious and educational entities, and wealthy families. It is an independent financial advisor office not affiliated with any one bank that is truly open architecture and dedicated to providing impartial advice in portfolio construction and management to its clients. Andrew is also Director of Capital Markets Integrity Corp, or the CMIC, which is owned by the Philippine Stock Exchange. mandated with overseeing and regulating the PSE trading participants with emphasis on capital adequacy, investor protection, and the regulation of market activity. Hello, Andrew. You can turn on your camera now and say hi to the audience as the floor
Hey,
is now yours.
Mon, you're really nice. I mean, that's very kind. Anyway, thank you everybody for taking the time. I hope I'm not going to bore you, but anyway, I hope we have a good time this afternoon. Nick, can we do the next slide? Then yeah, here. This one's great. So let me. It's probably good to just come out and say it, but investing wise, last year was horrible. Okay? Your average bond portfolio was probably down 10 to 20%. Your average equity portfolio was down 15 to 25%. Only oil and gas did very well. Now, the difficult part about this is that the average bond investor is self-describes as conservative. The average equity investor self-describes as aggressive. So this is probably more painful for bond guys than anybody else. But we'll get to the whys. But just to put things in perspective, and yet in real life, it really wasn't so bad last year. You were going out for the first time in 3 years, seeing friends, traveling, all the things you missed. So maybe you didn't notice your investments too much, but anyway, we'll go through it and you'll see why. Nick, can we do the next slide? Okay, take a look at this graphic. And you'll see that last year commodities did best. Cash did pretty decent. And I'd like to just point out, fifth from the bottom is DM government debt. That's basically developed market bonds. And you'll see that they did minus 17.5. This year, on the other hand, I'd like to point out that commodities are now the worst performing year to date. And the point here is, okay, so why did commodities do so well last year? That's basically oil and gas and all the metals you need for energy transition, which is a huge theme. And then you had, of course, the war. So why are commodities at the bottom now? Well, because the war fears in Europe have abated somewhat. And number two, there is, because of all the rate hikes, there's a lot of talk now about recession, and commodities are very sensitive to that. The point is, the drivers vary from asset class to asset class. And once you understand the dynamics behind it, it's very easy to tie it into the news flow and understand what's going on. Nick, can we do the next one? Okay, so this was, as I said, it was a horrible year. Everything was down. But I want to just point out that if you look at the chart, you will see that in October, it seems to have bottomed out. And we've since had a bit of a stealth rally. So, amidst all the gloom and doom, you have to remember that, take European equities, they're basically up about 20-25% from that October low. If you look at the NASDAQ, it's the same. Year to date, it's up 16%. So, in other words, when do you buy? Well, the thing is, it's very hard to time the market for the simple reason that when the markets are high, and you should probably be trimming a bit, there's a tendency to be a bit greedy and think, I can get some more return. And at the bottom of the market, nobody really has the courage to buy when the markets are really tanking. So it's very hard to say. You just have to stay invested. Okay, let's go to the next slide. So what I find is very useful to learn from what went wrong the year before. Now, last year, there was truly a series of, there was a lot going on. So, number one, I didn't expect Russia to invade Ukraine, honestly. And 2 days before Russia invaded Ukraine, because the Russian indices had come down a bit, I actually bought an ETF focused on Russia. 2 days later, they invaded, and boy, I've never lost 95% of my money so fast. Okay. Now, what did that lead to? That led to commodity price spikes, especially energy, but really including stuff like fertilizer and everything, because Russia is a major commodity producer. Up to now, with all the sanctions, you might notice the only thing they're not sanctioning is uranium, and because Russia is a major producer. But so what about energy? Okay, that led to a spike in inflation. Prior to this, I think Chair Powell and probably a lot of investment professionals thought that inflation was going to be transient. Transient because you had, if you consider the pandemic as a war, which you might, in terms of dollars spent in stimulus and lives lost, just to point out, for the US, for instance, 1.1 million lives lost. That's more people than they lost in World War II, right? So it looked like it may be just a transient inflation. But what happened was Powell, with all these commodity spikes, had to start raising rates. And I think rightly so. He was very, very aggressive. Prior to this, the Fed used to hike rates by like 25 basis points, and they did 475 bonds very, very fast. What did that lead to? Every central bank in the world had to follow or see their currencies crater, ex-China and Japan. But even Japan's currency really tanked, which is why it's nice to go to Japan now, by the way. If you notice in the Philippines, Philip Medalla at first said that he didn't have to raise rates, and you promptly saw the peso go to about 59. Since then, he has, if Powell hiked 75, you hike 75. That's what you had to do. It's because a central bank cannot, there are three things they want to control. One is the convertibility of their currency. Number two is you can control interest rates. Number three, you can control FX rates. You cannot control all three. You usually get 2 out of 3. Something's going to tank. Like China, for instance, they can control their exchange rate. They can control their interest rate because the currency is not very convertible. Now, but anyway, back to China, their reopening also took a lot longer than anticipated. And Nick, can we have the next slide? Okay, so I thought I'd give you a word on interest rates and show you how aggressive that rate hike was. In January last year, Fed funds were at 0.5 to 0.75. The most aggressive year-end forecast in January 2022 called for 1.25 to 1.75. The Fed's own forecast in mid-year last year was for a terminal rate, meaning the rate at the end of the year, of about 2.75. Well, now it's 4.75 to 5, may go a bit higher, depends on inflation. But for the moment, it looks like the Fed will just raise one more time, so 25 basis points. This is regime change after 14 years of zero. And really, if you look back further, bonds have been a great investment since about 1980. And so it's been a 50-year run of rates continually going down. Well, now they're starting to normalize, and that is huge. And I'll get to why later. Can we do the next slide? Okay, what are the implications for bond investors? For bonds, it's really all about rates and counterparty risk. So as interest rates rise, bond prices tend to fall and vice versa. I would just like to point out, this is relevant to Silicon Valley Bank. Duration risk is the sensitivity of a bond to a move in interest rates. In general, the longer the bond, the greater the movement. The average bond with a duration risk of 10 years will in general move plus or minus 10% for a 1% movement in rates. In essence, this is why bond investors took such a beating. In effect, the rate increase was 4%. So today, you can actually buy an investment grade bond, 3 to 4 years, single A, final maturity, and get a yield of about 5.5. Okay, so last year, just to remind, To get 3%, you probably needed to either go long or go down the risk thing. So say to get 3% this time last year, you probably had to buy like a 10-year country garden. And we were just talking about duration risk. You can see that's why, well, basically the bond market's broke. Okay, Nick, the next slide, please. Okay, how about equities? The thing you have to remember about equities, it's all about growth rates. And it's all about growth and rates, the rate scenario. Last year, and really up to about 2 weeks ago, the rate scenario was very unclear, and therefore growth was also very unclear. Equities, if you look at all three, you'll find what it is uncertainty. And if there's anything that equities do not like, it's uncertainty. They didn't know where rates were headed because the Fed announced they were data dependent. They didn't like the war, and they do not like commodity price spikes. Now, let me talk a bit about tech. Why did tech fall so much last year? And there were really big drops. When you have high growth, that implies that much of the growth is in the future, sometimes very far. So how do you value that? The preferred method is a model called DCF, which is discounted cash flow. Meaning you discount the growth back to the present so you can value a stock. Now, generally, analysts like to use the 10-year treasury, which is going crazy. So how do you value a stock when you don't even know what discount rate to use? And that just underlines the problems with uncertainty. Next slide. Okay, just to show you how quickly things have moved in the past 2 weeks, this slide was prepared last Friday. Look, if you look at the first one, it says, we simply do not know where Chair Powell's terminal rate is, and I suspect neither does he. Well, I think that's become a bit more certain, and I'll get to why later, but when you raise rates so quickly and unexpectedly, things tend to break. Generally a credit event, so you have SVB. You may have commercial real estate in the US. Now, the war in Ukraine is not going to end anytime soon. But there's a flip side to that. And, basically the world is still coming off a war. So still trying to figure out how habits have changed. When you move from a wartime to a peacetime footing, it takes a while. In 1946, you couldn't buy a car because Ford, Chrysler, and GM were making tanks. In 1948, the headline inflation rate in the US was 20%. So it takes time. And sometimes we're a little too, pushy. We want to know what's going to happen. In New York City, primetime dining hour used to be 8 o'clock. It's now 6. Because maybe people have learned that they want to watch an episode of Netflix before going to bed. I'm sure you guys go home a bit earlier now. I haven't been in a bar in 3 years. Okay, next slide, please. On the bright side, okay, we've got China reopening. Now that's going to depend very much on how robust that opening is and how quickly it happens. But we are lucky to be in Asia because don't forget, China, while a big exporter, is also a very big importer. They also have a lot of tourists. Thailand's economy, which is very dependent on tourism, looks like they're going to get a 3% boost just from that. If you also recall, when the president visited China January 3 to 5, China just put in an order for $4 billion worth of durian. That is a big help to us. Now, number 2, C seems somewhat more business friendly. As you can see, yesterday, Tencent jumped 6%, which is the first time since the pandemic. They are growing. Pandemic supply chain shortages seem to be easing off. So you actually see freight rates down now. Chips are more available. So it's interesting that for a durable good like a fridge or a TV, prices are down, actually. Better to buy a TV than an onion. Anyway, so provided we do not see. The thing about Ukraine is you have to remember three things. What drove the world crazy last year was three E's: energy spikes, two, the risk of expanding the war, number three, the risk of escalating the war, meaning to go nuclear. Now, with regard to the first one, you need to look at oil supply chains and see why I don't think we're going to get any more spikes. And it's very simple. So Russia used to supply Europe, America took care of itself, Middle East supplied Asia. Those supply chains have been completely upended. And so now Russia sells to China and India, whereas the US and the Middle East supply Europe. In a sense, the Russians gave up a client who paid in full and on time for two clients who suddenly want a discount. They want free shipping, they want free insurance, but the Russians just have to do it. So what happens is, because of this, their brand of crude, and I'm sorry if I'm boring you, but I'm really into energy, is $42, where Brent is about 70. So big discount. It's even below the sanctions cap of $60. So that goes to China, and say Sinopec is the world's largest refiner, and they converted it to diesel and sell to us, for instance, but that's sanctions free because that oil is now Chinese oil. So I don't think we're going to see an energy price spike. In fact, if the US does go into recession, you might see oil prices go down further. Now, the bigger part of the rate hikes do seem to be behind us. The Fed has indicated that maybe 25 basis points, then no more. And the last thing is cash has a return for the first time in a long time. And that's no bad thing, especially if you're a retiree. Suddenly your income is more predictable. Right? So let's go to the next slide. Thematically, I wrote this a week ago, and the first one is probably wrong now because now the rate picture seems to have sorted out. So just to run through some numbers, so you have the NASDAQ up 16%. Meta, which is Facebook, is up 70%. Apple is up 23%. This is all year to date. Microsoft is plus 16, Netflix plus 8, Google plus 20, Amazon plus 18. So you see the effects of a clearer rate picture very quickly. So the NASDAQ was going up all through these bank problems. Okay, healthcare and biotech, we still have an aging population. So you're going to need that. You know, my mom had a stroke about 7 years ago, so I am very up on what's happening with strokes. I'll give you an example. There is a new procedure called EVT, which was developed with the people who do heart stents. So they worked with cardiologists. And usually when you have a pretty big stroke like my mom had, it leads to years of therapy and care. And with EVT, strangely enough, the more severe the stroke, the faster you recover, and you can basically walk out in 4 days with no impairment. And in the Philippines, I just had to put in a little plug here. It's available at St. Luke's, both QC and BGC, at Medical City, Makati Med, Asian Hospital, PGH, and East Avenue. So, anybody with a lot of cash, think about the visas of this world with trillions of dollars go through the systems every day. Or HSBC, who is the clearing bank of Hong Kong, and all that float, all that currency in circulation is free float. So they're making a lot of money. You still need infrastructure, including data centers and logistics. They're basically inflation index. But the point of this slide is, I guess, to show you how quickly things can turn around these days. I mean, what was, everybody, Powell went from saying a month ago that he may raise 50 basis points to now saying maybe the work has been done for him. Okay, let's go to the next. Okay, you guys probably never heard of Silicon Valley Bank till I personally love this bank. I used to own a lot of the stock. Well, I don't now because it's under receivership, so that's a loss, right? But basically, it's a liquidity issue. It's not a solvency one. They have a very unique franchise. It's a very good example of what can happen when rates go up too fast and quite unexpectedly. You have to remember they didn't buy subprime. They bought U.S. Treasuries, which are the safest instrument on the planet. Maybe they bought too much and bought it for too long, but this is not subprime. I want to emphasize, this is not an asset deterioration problem. This was a rate mismatch. Yeah, you know, SVB is a very unique institution. They had only 20 branches in Silicon Valley, and yet they had 40% of Silicon Valley's deposits. They had 45% of companies that were venture capital or private equity funded, and they had about 50% of all the companies that went IPO. So to give you an idea how this works, usually if you're a tech startup, and I've had a number of friends go through this, your VC tells you where to put the money, or they suggest, because tech geeks tend not to be very good with money. So they generally go to SVB. The minute SVB sees you, they come to you and say, we'll give you a savings account, a checking account, credit cards, mortgage, auto loan, whatever. They're very holistic. And then as you go through funding rounds, they will lend you money. They may put money in on a venture capital basis as well. And they have an investment bank to take you through all those funding rounds and then go into an IPO. And then when you've IPO'd, you obviously have a lot of money now. They have a private bank that takes the money. So it's a unique ecosystem. I hope it's preserved. I still like it, despite losing all that money. But so SVB, is it systemic? No, probably not. You know, they had a very interesting side business. If you visit their head office, they lent a lot to the winery industry. So they had bottles of all the wineries they lent money to. So I guess the winery business is going to have a problem with funding. The big problem for SVB is tech. And, you know, I don't really blame them for buying those treasuries, because from 2018, they went from $60 billion in deposits to about $200 billion. And that came partly because of the tech boom. Money was flowing to VCs, PEs, and there was, and people were not spending money. So they had to put it somewhere. Your bank, I mean, you can't take all of these deposits and not put it somewhere. And that's why they bought US Treasuries. And that's what brought them down. Okay, next slide, please. Okay, now we got Credit Suisse. Okay, what precipitated it? The proximate cause was their biggest investor, the Saudi National Bank, which owns 10% of Credit Suisse, said in an interview when asked if he would buy more Credit Suisse shares or give support, he said, and I quote, absolutely not, because of regulatory issues. He couldn't own more than 10%. Unfortunately, social media picked up the first part of the sentence, not the second half. And I guess if your biggest investor says, I'm absolutely not putting in another cent, it doesn't look good. Okay, next slide, please. Okay, I want to emphasize that this is a very different animal from SVB. SVB came down really because of the duration risk that we were talking about earlier. So they were taking pretty big losses. They were facing probably $2.5 billion in losses, which they had to sell because depositors were leaving. Now, if you took that same measure, Credit Suisse's loss on its securities holdings came to about $50 million, which is nothing. Solvent, very liquid. The problem of Credit Suisse, unlike SVB, was a cultural issue. And I'd like to point out this very nice slide that Mon put together. And it just shows you how many times they got fined. And that's not even counting money laundering in Bulgaria or Mozambique fishermen. So anyway, it's a culture issue. Anyway, next slide. Okay, $54 billion. At that point, though, they were losing $10 billion a day. And so that's why we come to the next slide. which is UBS agrees to buy Credit Suisse. There are a few things I'd like to point out here. 2008, UBS at the aid, CS did not take a cent of government money. So basically it's a 0 to 0. So two very different banks. You might say, so what are the similarities? Okay, number one is they had exposure to a pretty sophisticated funding base. In the case of Silicon Valley Bank, it was tech investors, and the case of CS, it was private banking clients. Now that base can effectively pull their money really, really fast. It's a bit hot, which now highlights why everybody's talking about the importance of retail deposits, checking, savings. They're very valuable now because they're very sticky. You don't insist on being paid. So they can pull it fast. The other thing is to keep in mind is they're very rate sensitive. So banks, if you got used to paying 0, they're suddenly having to compete with money market funds that pay 4.75, or even a 1-month treasury is about 4%. The other thing that I'd like to point out, and I just had a discussion about this the other day, is the other two things that made them similar is the information disseminated really quickly on social media. And number 3, with e-banking, that proved to be a very, very, very potent combination. In the old days with a bank run, what you could do, I mean, you'd hear it from a friend, maybe you ask another friend, go down to the bank and get in line and take your money. These days, you don't have to do that. You just do it electronically. And unfortunately, everybody reads social media and not everybody checks what's going on. Now, from a regulatory standpoint, you have to wonder how you can even regulate that. Okay, we can get to the next slide. Now, I thought I would diverge a bit and say why banks should matter to you. And the perfect transmission mechanism for economic activity. By raising rates, the Fed was working really on the demand side for credit, meaning the borrower side, dampen demand by raising the cost of money. Generally, as I said earlier, the Fed raises till something breaks. This has happened. Now, in times like this, if you're a bank that's losing deposits, for example, the US regional banks, you tend to set aside more money for liquidity. And you generally do that by not lending. This has the effect of constricting credit. We're now talking about the supply side of credit. Simply put, this means your loans may not be approved, from business loans to mortgages to auto loans to appliance loans, which means in turn that you may not be able to expand your business, buy that house, car, washing machine, you name it. And that is a constriction of the supply of credit, which will lead to, and it is a perfect antidote for inflation because you will slow down economic activity. Anecdotally, you know how Americans love to buy a bigger house all the time. So a year ago, to put things in perspective, the interest rate, mortgage rates, and I just like to remind you that Americans have the unique ability to borrow for 30 years at a fixed rate. Locally, you can borrow 20 years, but it will reprice every 5, which means a lot of interest rate risk is to us, the borrower, rather than to the bank. And today, it's more like 7% in the US. In the Philippines, I know a mortgage used to be about 4%. Now it's about 7.75. So you're thinking of buying a bigger house, and but you're safe because your mortgage is 2%. Suddenly, if you want to buy a bigger house, you're going to have to refinance at 7, and that is not very palatable. So you're starting to see housing numbers come down. The point of this is the Fed can, in a sense, now let the bank do its work for them. I mean, if credit conditions truly tighten, that would be like the Fed raising rates another 1%. The problem is that it can be disorderly, and the Fed has far less control of the supply side than the demand side. Okay, we can do the next slide. So what are we to do? Okay. If you're very worried, you can consider cash because it makes money now. We're talking like a money market fund. You can consider bonds. It benefits from lower rates, but also you get a pretty good coupon now, say 5.5. That's not too bad. With limited, that's a 3 to 4 year bond, limited duration risk, limited credit risk, probably a single A like, say, JP Morgan Chase. And while you can expect volatility in equities, well, as my boss used to say, you gotta be in it to win it. If you're not invested, there is no downside, but there is also no upside. Okay? And do a long-term plan. I notice investors in the Philippines tend to love tips. I have doctor friends who keep calling and say, what's the latest tip? In my own experience, tips are for waiters. You need to have a long-term plan, which means you need to sit with your Sun Life advisor. To reiterate, you got to be in it to win it. Now, as to the exact mix, well, my boss also used to say there's a sleep return ratio. So that depends on you. But your Sun Life advisor is going to help you figure out exactly what that mix is, what your long-term goals are. Everybody varies. Do you want to retire early? Personally, I love working. So, well, most of the time. Last year was really a bummer. The last 2 weeks have been a bummer. But most of the time, I like what I do, which is managing money. So, as I said, your Sun Life advisors are professionals. They know what to do. You need to sit with them. So even today, I would say if you expect a lot of volatility, and we ran through some numbers earlier where you had Apple up 23%. I mean, Apple and Microsoft are basically a bigger part of the S&P 500 than they've ever been. And that's despite all these problems with the banks. So anyway, I would just like to thank you for taking the time. And if you have any questions, I'm happy to listen to them now. Thank you. Thanks very much.
All right. Thank you so much, Andrew. I really like the sleep test that you mentioned. Actually, I've always used that every time I talk to clients. I actually call that the sleep well at night test. Like if that's the number one indicator of your risk profile, diba? If you can't sleep well at night.
It's funny, Mon, because on the other hand, there are people, if you keep them in cash, they can't sleep because they feel they're missing out on opportunities. And
right.
I would have been actually so far this year, much to everybody's surprise.
Right. Because if you were just sitting in cash last year, you'd be losing out on inflation also, no?
Yes.
Yeah, diba? So I guess for the audience appreciation, I prepared and collated some of the questions we received from clients and advisors. If we could show some of the first questions. Andrew, so do we think the extraordinary actions of the Fed and the concerted efforts of central banks can avert a global financial crisis? Or do you
Okay.
think this is the start of a full-blown banking crisis?
Okay. Let me expand a bit on what I said earlier. This is not 2008. I mean, I lived through that and it was horrible. Okay. The questions then had more to do with asset deterioration because you basically had all these banks investing in subprime, which were really toxic assets. And the worry was that if credit had shut down, and there were a lot of derivatives thrown in, which is why AIG had to survive. Because if it didn't, it would have taken down half the world's banks at the same time. So was it systemic? This time, the problem is not the big systemically important institutions. In fact, money is flowing into those institutions. It's a confidence and liquidity crisis. I don't think it spirals. In fact, if you look at the banks in the US now, they've more or less stabilized. So no, and again, I draw your attention to the fact that SVB was not investing in subprime. They bought US Treasuries, which is about as safe as you can go. Most liquid, safest market in the world. So maybe a bit too much, maybe a bit too long, but what can we do?
All right. Thank you so much for that. And that's very comforting. Next question, we'll bring it up here. We're going to try to do more quick fire Q&A in the interest of time. So how have your clients in Beacon been reacting given the concerns now in the banking sector? Have they been, pulling out? Have they been investing? Are they doing local,
No,
global?
I think, as I said, if you have a long-term financial plan in place, yeah, you have to be prepared for this kind of thing. And there, some clients are hiding out in bonds for the next few months. Some are hiding out in cash. Some remain fully invested. So it really depends.
All right.
I'm
Thank you.
assuming Sun Life clients are the same.
Yes, you are correct. Next question, please. We have, given the stress now in the banking sector, do we think now that the Fed can now pause sooner on the rate hikes and tightening? I know that last night they just had a meeting,
Yeah.
the Fed.
If inflation stays more or less where it is, or hopefully starts coming down, the Fed at this point, because of this banking crisis, doesn't actually have to, I think, raise. He can sit back and let the banks do it. In America, it's because of liquidity concerns. So you set aside more money for withdrawals. In Europe, it's a different thing. There, if you recall, the Swiss National Bank effectively called the COCOs of Credit Suisse. Now, the European banks, more than American banks, they use it as a big funding source. And if that tap is closed off, one avenue, you can still raise equity capital, but basically you got to shrink your balance sheet, which means that's tightening too. And it's very hard to control when it stops, is the problem. The Fed can start cutting rates when they need to, but if the worry is that banks are fearful of lending out, then effectively you can't tell them to lend.
Right. Okay, next question, please. We have here, because the Fed met last night, right? And they said they're only going to do 25 basis points hike. If the Fed will eventually pause on the rate hikes, because they did signal that in their comments last night, could this be the cue for a meaningful rebound in global markets?
Well, Mon, you saw the Nasdaq is up 16% this year. I think that's a rebound. Of course, with the individual companies, it's idiosyncratic, but more or less, as I said, if you now know the discount rate to apply to your DCF model, you can at least start valuing it. You're not going in blind or making a guess. So, as I said earlier, you got to be in it to win it. And if you look at the nature of equity market rallies, I'd say 80% happens in the first 2 days. And you can't time that. You can't jump into a stock, because by the time a stock has moved up, much of that jump up is already there. So unless you're a hedge fund, who knows within seconds, right? That's why everybody pays attention to earnings calls, right? So you just have to stay invested. It takes some pain. But as I said, even for a bond investor today, you're making 5.5. It's not a bad thing.
Yeah, it's a peace, peace of mind play, as you said, no?
Yes, absolutely.
Diba? Yeah. So let's go to the next slide, please. Since we're talking about a recession earlier, is the supposed U.S. recession still a concern, or will U.S. stocks still drop further if May recession?
I think, prior to these last 2 weeks, you basically there was talk about everything. There was no landing, soft landing, recession. Okay, those recession fears have come up. And that has a lot to do with the tightening of credit standards. As I said, there is no bigger dampener if somebody doesn't want to buy a house, or he can't get a loan to buy a car, can't get a loan to buy an appliance. But even Chair Powell said the other day, he doesn't know the extent yet. It just started. It's 2 weeks ago. So will stocks drop further? Well, strangely enough, tech looks pretty good, because in a recession, you want to avoid the cyclicals, because the cyclicals tend to be dependent on economic activity. On the other hand, tech in general are what are called secular growers. They're not dependent on economic activity. Of course, to some extent, Amazon, for instance, but they grow on their own because they're innovative. And that's worth something. And as I said, now you can value them. So it really depends on which stocks. It's a lot of moving parts. Yeah. But yes, in general, if the US goes into recession, you have a problem.
Okay. Next, please. So, and for this question, this is like a common question we get right now. No, are our local banks and financial institutions sound and stable in light of all the banking issues globally now?
Okay, let's get into regulation, right? So after the financial crisis of 2008, any bank in the US above $50 billion was very tightly regulated. 2018, President Trump pushed through some legislation that said it only applied to 250 billion. And if you notice, Silicon Valley Bank was 212, right? So what's happening now, tighter regulation builds trust, right? So in the US now, what you're seeing is deposit flight from smaller banks that were more lightly regulated into the big ones that are very heavily regulated, right? So in Europe, you don't have that same problem because in Europe, any bank above 10 billion gets the same regulation as anybody else. In the Philippines, we are very heavily regulated here, and we don't have as much interest rate risk because, well, most of it is passed to us, the borrowers. So if you take a mortgage, they reprice every 5 years. There's very little rate risk there, as opposed to a 30-year mortgage. I mean, if an American bank wrote a 30-year mortgage 2-3 years ago, that's sub 2%, and they're going to have to hold it on their books for 30 years. So the full interest rate risk is on them. Okay. I
Right.
hope that helps.
Yeah. Thank you for
So
that.
do not run and take your money out of the bank. That's really stupid.
Okay, you heard that, everyone. So next question, please. So do we think that
Oh,
bonds?
Mon, can I
Yeah,
just say something?
yeah, of course, of course.
Anecdotally, I heard that some seniors have been taking money out of the banks and putting it in the vaults. Now, a word about vaults. You're doing the thief a favor because he knows what to take. I mean, at the risk of an hernia, of course, but he doesn't have to look through your house. He sees the safe. He knows the money's there. So, I mean, if you're thinking about safety of your money, keep it in the bank or buy a money market fund. You're fine.
Thank you for sharing that. No. So here, you talked about bonds earlier. Do we think that bonds will outperform equities now, given the outlook?
That's hard to say. I think bonds do give you a more bonds. Okay. I think through the 15 years of zero interest, you had a lot of people who were forced, in a sense, to go into equities because bonds just yielded nothing,
Correct,
right?
correct.
And as I said, you probably had to go out in the maturity and down the risk scale to get any sort of meaningful return. Now, I would like to point out something to investors as well. Investors have a tendency to try to squeeze as much yield. I've found in life, well, in the markets, I mean, for a given amount of risk, you will get a given amount of return. And so what you should adjust is actually your budget, not try to squeeze more out of your investment. Because as an investment professional, say a US Treasury will yield last year, say 0.85, whereas a country garden will yield you 3. Nothing is free. Those AT1s of Credit Suisse that were called were yielding 9.25. They're very popular with people. So I'm just saying, you have to stop trying to squeeze your investments for more money. So do I think bonds will outperform equities? I think the question is more properly, can they give you a predictable income? Likely, yes, because rates have come up quite a bit. Equities over the long term, I think there's an allocation everybody should have. I mean, there are 2 asset classes that almost by definition will go up over, say, a 30-year time frame. One is real estate, because the supply of real estate is not growing and there are more and more people. The other one is because there's innovation. Just remember about this, your return is capped at that coupon that you've agreed to. If you're happy with it, that's fine, but there is no upside. I mean, I say lower rates, which means though that you're in a recession, which is not so good. Or you
All
do
right.
cash 6 months, 4.7.
All right. Thank you for that. Next
Again,
question,
that
please.
individual investment.
Correct. So here's one. No, this is a common question we get. No, we wanted to get your view for local equities. When do you think the PSEI will go back to the pre-pandemic levels of 8,000, and what can bring us there?
Mon, I gotta tell you, I don't do a lot of local equities. I tried applying the way I manage portfolios to local equities. I tried it on myself, and I lost a lot of money. So you're probably better off asking a broker about this. But I do think the Philippines were in Asia to begin with. As I said, China is going to be buying more from us. That's helpful. But the other thing to remember is that in the metals world, the Philippines is a rock star. We have the world's third largest gold reserves, proven, fifth largest copper. And copper is vital to energy transition, which is the other big theme that's going on in the world. When you want more EV, you want more grid, you need more copper because it is simply the world's best electrical conductor, right? The other one, far second, is maybe aluminum. But in the Philippines, we have a mine in Cotabato called Tampakan, which, when it becomes operational, unfortunately, it's very long tail, has the potential to add 5 to 10% to GDP. So over the long run, if you look locally, PSEI aside, you'll find, say, DMCI is doing pretty well. They own part of Tampakan. They also produce a lot of coal. So that's, the world discovered last year that you can't just depend purely on renewables. You need the whole gamut. You need everything from coal to oil and gas to nuclear. And because you have to keep things affordable. I mean, sometimes Europeans get ahead of themselves. So I was talking to a friend of mine, and he said, why don't you do more renewable? And I said, you also have to pay attention to the price of energy. I said, in the Philippines, as we know, there are some of our countrymen still cook with fire. And it's not because they're into grilling. There's no, they don't have power, right? So how do you do that? Just saying. So I think the long-term future of the Philippines is pretty bright. And as long as you're patient, you'll get to the pre-pandemic levels. And as I said, we happen to be in a nice region of the world. Suddenly, we're also strategically very important. So a friend of mine tells me there are more spies, both Chinese and American, in the Philippines. Looks like Lisbon in 1945. So, there's a tension on us. So I think we'll do well.
All right, that's comforting. Thank you, Andrew. For the final few questions, if you can go to the next slide, please. I might skip this one already because you clearly already said that tech has been rebounding this year, no? So we'll go to the next question here, the last two questions. For young investors, no? If whether they be conservative, maybe balanced, or even aggressive, what kind of, quick asset allocation could you recommend to them, and what funds could be good at this time?
Okay. First of all, I think if you're a young investor, you should be aggressive because let's say you're 20 or 30, you got a lot of years to make up for mistakes. If you're 65, you should be mostly in bonds because, well, let's face it, you need a predictable income. But for a young investor, yes, they should be aggressive. I think aggressive for me means 100% in equities. Or you could do 80-20, maybe 80% equities, 20% bonds, just as stabilizer. If you're balanced, you could do maybe 60% bonds, 40% equities. If you're conservative, you should probably do like 70% bonds, 30% equities, so you have a little kicker, right? But again, that depends on your sleep return ratio. If you're a jumpy type, then you should have more bonds. And if you're more calm, which you need to be these days, then you should be buying equities, I think.
Ayan guys, no. So there you have it, no? Based on asset allocation recommendations on your risk profile, which is determined by the sleep test ratio.
But Mon, I should mention something. And for all the investors out there, you have an invaluable resource with your Sun Life financial manager. You need to talk to them. They know what to recommend to you, right? And they will know your situation. So you just have to figure out what your long-term goals are. I mean, the funny thing, Mon, is in my long career, if you ask investors, do you want a return? Everybody says, I want a return. But if you say, how much risk are you willing to take for that return? Everybody says zero risk. So it's really, I don't know. But what you need, and I think that's vital to remind people, Sun Life trains their advisors to help you. So you should make use of that resource. I mean, even if you don't buy anything at the beginning, you need to know. And maybe start off with a money market fund. I mean, at least earn some money on your money, right?
Completely agree. Thank you for that, Andrew. So the final few questions, if we can just show it now. Okay, so we have a lot of clients who are still down naturally, diba, with their local equity funds. Maybe even they bought global equities last year and they're down now. What can you advise? Sell, hold, cost average now?
I wouldn't sell. Um, I think when you opportunistically see good situations, which generally are not very pleasant environments for investing, but let's say you like global equities and you think maybe there's a little too much pain. You know, it's like 3 years ago at the height of the pandemic, Lexus went on sale and it was 0%. And it was easy to get one then. Now it's pretty hard to get one. I understand the wait for a Super Grandia is something like 3 years, right? But you know, at the time the price seemed right. 0% looked good. I looked at the monthly, I could afford it. So I mean, I'm not the sort of person kasi who tries to get always the best deal. As long as it's okay now with me, I will buy it and I'm patient. So as I said, if you reach the point, say last year or even this year, when you're comfortable with the price, and you should add, absolutely. As I
Yeah.
said, you know, maybe there will be a lot of volatility in equities. So actually, interesting thing to this whole bank thing, there was even more volatility in bonds. So I just point out the 6-month US Treasury bill that has almost no duration risk, right? And yet, in the last 2 weeks, it went from a 5.3% yield to a 4.7% yield. That is unheard of. I mean, I can see the 10-year Treasury whipping around, but the 6-month bill. So, I mean, you just have to see where you're comfy. For a lot of people I talk to, I find 5% is a magic number. Basta you give me 5%, medyo sure, okay na ako
Yeah.
dyan,
Yeah.
right? I mean, most people, to be honest, most people don't aim for, you know, high teens or whatever. They just look at something they can live with.
Yeah, I agree. People have understood the term reasonable returns already.
Yeah, reasonable.
Yeah.
And I think after you look at all these things, it's your best with.
Yeah. I guess one last quick fire question,
In
no?
other words, don't be greedy.
Of course. Oh, ito, quick fire answer tayo dito, Andrew. Were you more bullish, global equities or local equities?
To be honest, about the same. I have a preference for global equities just because I find it more interesting, and I'm a very curious person. But it should be about the same. If the world rebounds, the world will rebound together. It's going to be a little less globalized, and but I think the Philippines is in a nice spot personally.
All right. Thank you so much, Andrew, for indulging me in all of these questions. No? And to
Sure.
the audience here, allow me to synthesize everything with some key takeaways. No? If we could go to the next slide, please. So some key takeaways for everyone, if you were listening and if you lost something earlier, the extraordinary interventions of central banks restored confidence and can avert a global financial banking crisis. Local banks and financial institutions here are sound and stable with no problems that the US banks or Credit Suisse faced. For medium-term horizon investments, consider investing in bond funds. As Andrew said, no, for a peace of mind investing play for decent returns given lowering inflation and rates. And Andrew said, no, tech stocks are rebounding. If you didn't notice, Andrew said kanina that Meta is already up this year around 60% to 70%, no? And that's just one tech stock alone. All the others are rallying again this year. Nasdaq is up 16% this year and will gain more ground once interest rates stabilize, no? And if we go to the next slide, now going back, with everything we've learned so far, how can we apply it to investing and how can we build our financial safety net? Number one, diversification, a time and tested risk management tool. It's best to diversify investments in many ways: short-term funds, medium-term funds, and long-term funds, spreading it across different asset classes from bonds, equities, and money market funds across different sectors and countries. No one knows for sure which one will outperform this year. But what we can do is try to have investments in many asset classes so that if one underperforms, others may outperform and hence save the portfolio from further downside risk. Next, here is one of the best ways you can build your financial safety net. This is just an illustration of what Andrew said earlier. If you're conservative, you can put 20% into equities and 75% into bond funds, no? If you're of balanced risk profile, we'd recommend having 50% bonds and Peso Starter Fund and 50% into equities. This way, you still have your portfolio into bonds and fixed income, which will stabilize your portfolio from overall volatility and at the same time giving you exposure to equities for some capital growth. And as Andrew mentioned, if you're aggressive and young, sabi nga ni Andrew, 100% mga equities because you can afford the risk because you're young. So that will give you the best exposure to more aggressive investments for long-term capital growth. Next slide, please. So going back to what Andrew recommends, no? So for cash, he kept talking about cash. What do we mean by cash, no? You can invest your cash into money market funds or our Peso Starter Fund. Our Peso Starter Fund has a forecast of 2.5 to 3.1% this year. We also have a dollar version, the Dollar Starter Fund, with forecasted returns of 2/4 to 2.75% this year. For aggressive investors who like stocks, we have our Philippine Stock Index Fund. The year-end forecast of Sun Life is 7,850. That's a 22% potential upside. But of course, as Andrew mentioned, if you can stomach the risks. We also have our World Equity Index Feeder Fund if you want to invest in global equities using your pesos. And with Andrew's recommendation to consider bonds, if you want to be exposed to a fund that invests in many bonds at once, you can try our Peso Bond Fund. We have a bullish outlook on bonds as well for Sun Life, and our forecast for returns is 3 to 8% in 2023. Next slide, please. Now, aligned with Andrew's outlook on bonds, SLAMCI is also bullish on bonds and bond funds this year. And hence, we published a material called the Sun Life Bond Fund Market Opportunity, where we outlined the reasons we believe this could be one of the best times to enter bond funds. Given the view of expected lower inflation and stabilizing of rates, we're already seeing bond yields at high levels, and hence, this could be a good time to invest in bond funds again. Next, we have cost averaging. Cost averaging has been one of the time and tested tools to reduce risk in investing. Breaking up your lump sum and going in the market in several tranches via cost averaging has been known to reduce overall risk over the long term. Some people even add bigger amounts when the market drops, as cheaper prices gives you more shares and better chances of higher gains once the market rises in the long term. Regular investing in small amounts goes a long way to building wealth. And my favorite slide, crisis equals market opportunities. No one can predict how long these investor worries may linger. We believe this year's episode of Market Volatility is creating opportunities for long-term investors across asset classes. Take a look at this chart. The blue line represents the performance since the year 2000 of the MSCI ACWI, or All Country World Index of Global Stocks, the top 2,500 stocks around the world. We can see here that the world is no stranger to crisis moments. These things happen almost every other year. Take, for example, the years of 2000 to 2003. There was the 9/11 terrorist attacks in New York. Meanwhile, there was the dot-com bubble tech crash and the Iraq War. Markets tumbled 50%, but rebounded 145% in the years that followed. And of course, the 2008 global financial crisis, where this was a full-blown liquidity crunch due to bad loans and a crash in the housing market. The market tanked 55%. But as you can see, it followed by a 9-year recovery bull run with a 213% gain over 9 years. In 2020, you had the COVID lockdowns and the market tanked 35%. But immediately, the market staged a very good market rebound at 95% recovery until the end of 2021. We can see here historically the rebound returns are even greater than the market corrections. In 2022, Andrew said we had the Ukraine war, high inflation, rate hikes, and this year we have some banking stress and turmoil with the SVB collapse. which may represent yet another opportunity for long-term investors. In fact, a Bloomberg article even said that top fund managers are already positioning for the next market rally as they don't want to be left behind when the market does a meaningful rebound rally. Next slide, please. Always think long term. Right now, you may think that things don't look good with so much volatility, but if you stay 5, 10, 20 years or more, volatility smoothens out. And staying invested lets you ride all the market rebounds as well, giving you better chances at positive long-term returns. Markets go up and down and usually recover even stronger than the sell-offs. Let's take a look at the 5-year historical performance of global equities in blue, US S&P 500 stocks in green, and the US Nasdaq tech stocks in red. We can see here, despite all the volatility, global equities have performed well over the past 5 years, led by the tech stocks, in fact. Let's take a look at the 10-year historical performance. You see how the gains have jumped significantly and how volatility seems to have smoothened out. You see the tech stocks leading at 351%, followed by US stocks and then global equities. And now let's take a look back at the past 20 years historical. Look at the tech stock performance, 1,045% return over the past 20 years. But here's what's interesting. PSEI, our Philippine stocks, is now at second place at 523%, followed by the S&P 500 and global equities. Returns tend to be better over the long run. Staying the course and staying invested is one of the best financial safety nets for you and your portfolio. Now, if you like to be exposed to global equities like tech stocks, in the next slide, and if you want to take advantage of market opportunities like the China reopening theme with a heavier tilt on emerging markets, we have an upcoming new global equity fund, the Peso Voyager Feeder Fund. Next slide, please. This fund is a global equity feeder fund that allows investors the access to global equities using Philippine pesos. The fund invests in an actively managed fund, which is our Dollar World Voyager Fund. In the next slide, you will see that it feeds and invests majority of its net assets into our World Voyager Fund, an actively managed global fund of funds that invests in offshore equity securities. The fund manager gives investors exposure into stocks from various parts of the world via partnering with major global funds such as Schroders, JP Morgan, Franklin Templeton, Nico Asset Management, and more. Finally, how is this different from our World Equity Index Feeder Fund or the WAFE? Well, WAFE is a passively managed index fund which tracks the MSCI ACWI benchmark, while the Peso Voyager Feeder Fund tracks an actively managed global fund of funds. Take note that this fund is not yet for sale, so please await our official product launch very soon. Well, there you have it, everyone. We would like to thank our guest speaker, Andrew Gan. Andrew, thank you so much for your time. It was a pleasure
Oh, thank
having you
you
on
for having
board.
me. Really enjoyed it.
I really had a great
I,
time with you, Andrew.
thank you, thank you.
Yeah. And
Invite me back.
we will, we really will. And a big thank you to all our dear clients and especially those who stayed with us till the end. Once again, I am Mon Osmeña, and on behalf of the SLAMCI team, thank you everyone for listening and have a great weekend, everyone. Thank you.